Hello, and welcome back to my channel, where we delve deep into the stock market, investments, and the economy. In today's video, we're going to unpack the recent stock market volatility and, more importantly, highlight three critical lessons that every investor should take away from this drama. There's no doubt the third quarter of 2024 has been eventful for investors. From fears over a potential artificial intelligence bubble to ongoing macroeconomic challenges, it's been a roller coaster ride. But does this volatility signify the beginning of something bigger? Or is it just another blip in the larger stock market cycle? Let's dive into the details and learn what the market is trying to tell us. Lesson 1. The market is going to fluctuate. Always. The stock market has been volatile, but that shouldn't surprise anyone. As the legendary J.P. Morgan once said, the market is going to fluctuate. While this may sound simple, it's one of the most important lessons for any investor. After strong performances in 2023, with many AI-driven stocks like Nvidia, Microsoft, and Meta reaching new highs, expectations became unrealistic. Many investors started to believe that the market could only go up, fueled by optimism around artificial intelligence. But the truth is, stocks can go down just as quickly as they rise. In the third quarter of 2024, investor sentiment changed almost overnight. AI optimism shifted to concerns about an overheated market, driven by macroeconomic risks, inflation data, jobs reports, and even geopolitical factors like the Bank of Japan's interest rate hikes. As a result, volatility surged to levels not seen since 2022. But let me emphasize this: volatility is not the same as risk. A common phrase among savvy investors is, volatility is not risk. Risk is the permanent loss of capital. The problem with volatility is that it triggers the cycle of fear and greed. When markets are volatile, many investors tend to make emotional decisions, buying high and selling low. To avoid this, we must remain rational, focus on the fundamentals, and stick to long-term plans. One of the keys to managing volatility is accepting that it's a natural part of investing. If you're going to be in the market, be prepared for it to fluctuate. Stay focused on your long-term goals and don't let short-term swings derail your strategy. Lesson 2. Diversification is not dead. In fact, it's more important than ever. Diversification is one of the most tried and true principles of investing, but in the recent past, there were headlines declaring the death of diversification and even the end of the 60-40 portfolio due to inflation's impact on both stocks and bonds. However, the third quarter of 2024 reminded us why diversification remains essential. While equities were sliding, bonds were holding up better. The U.S. Treasury yield dipped, which sent bond prices up as investors sought safe haven assets. Multi-asset portfolios with a mix of stocks and bonds outperformed pure equity portfolios during the sell-off. Diversification isn't just about owning a mix of stocks and bonds. It's about understanding how different assets react under various conditions. In 2022, stocks and bonds both fell due to inflation and aggressive rate hikes from the Fed, making many question whether diversification still worked. But this year, bonds have returned to their role as a portfolio stabilizer. The key takeaway? Diversifying across multiple asset classes, sectors, and geographies remains one of the best strategies for protecting your portfolio from unpredictable market movements. You don't need to predict where the market will go next. You just need to prepare your portfolio for a range of scenarios, and diversification is your best defense. Lesson 3. Change is the only constant in the market. The stock market is always changing. Trends that seem permanent today may fade tomorrow, and sectors that are out of favor today could lead the market tomorrow. This is what makes investing both exciting and challenging. For instance, in the third quarter of 2024, we saw a shift in market leadership. After years of growth stocks dominating the market, value stocks finally had their moment. Small-cap stocks also rallied, while many of the large-cap tech giants that led the market for so long began to face headwinds. Is this a temporary rotation, or are we seeing the beginning of a new trend? Only time will tell. But history reminds us that nothing in the market stays constant. After the dot-com bubble burst in the early 2000s, value stocks outperformed for years. Conversely, after the financial crisis of 2008, growth stocks dominated for over a decade. This kind of rotation can also happen across geographies. For much of the last decade, U.S. stocks outperformed their international counterparts. But in 2024, the Morningstar Global Markets ex-US index began to outperform U.S. stocks. Is this the start of a new trend favoring international equities? It's possible, but again, it's impossible to predict with certainty. As investors, we need to remain flexible and ready to adapt. This doesn't mean making drastic changes to our portfolios based on short-term trends. Instead, it means being aware of the broader market context and understanding that shifts in leadership are a normal part of the market cycle. What's behind the recent stock market drama? Now, let's explore some of the technical reasons behind the recent market turmoil. Much of the recent stock market drama can be attributed to rising concerns about the health of the U.S. economy, particularly in the labor market, as well as diverging monetary policies across the globe. One key factor contributing to the sell-off was the carry trade, where investors borrowed cheaply in Japanese yen to invest in higher-yielding assets elsewhere. When the Bank of Japan unexpectedly raised interest rates, the yen spiked, leading to the unwinding of these trades. This, in turn, triggered a wave of volatility across global markets. At the same time, tech stocks, which had been market leaders for much of the year, came under pressure. Investors began to reassess whether valuations had run too high, particularly in light of concerns about the Federal Reserve's next move on interest rates. In addition, we saw thin trading volumes during the summer months, which amplified price movements. When markets are thinly traded, even small shifts can lead to exaggerated moves, as we saw in late August and early September. Don't predict, prepare. So what should investors do in the face of such volatility? The answer lies in preparation, not prediction. Market timing is a notoriously difficult game. Trying to predict the exact moment when markets will turn can lead to costly mistakes. Instead, focus on building a diversified portfolio that can weather different market conditions. Hold a mix of stocks, bonds, and perhaps alternative assets, and be prepared for volatility. Stay informed, but don't react impulsively to every market move. The best strategy is to remain calm, focused on your long-term goals, and avoid emotional decision-making. Key takeaways from recent stock market volatility. In summary, the recent stock market drama has been a reminder of three important lessons. 1. The market will always fluctuate. Volatility is part of the game. 2. Diversification remains a powerful tool for managing risk and protecting your portfolio. 3. The market is constantly changing, and no trend lasts forever. The key to successful investing isn't about predicting the future, but preparing for it. By staying diversified, maintaining a long-term perspective, and keeping your emotions in check, you can navigate the ups and downs of the market with confidence. If you found this video helpful, don't forget to like, subscribe, and leave a comment below with your thoughts on the recent market events. I'd love to hear from you and discuss how we can continue to learn and grow as investors. Thanks for watching, and I'll see you in the next video.